Does Oregon estate tax affect trusts? Have you ever wondered how the Oregon estate tax impacts trusts? This is an important question for anyone involved in estate planning in Oregon. The Oregon estate tax can indeed affect trusts, but the specifics depend on the type of trust and how its assets are treated for tax purposes. First, let's talk about the Oregon estate tax itself. As of 2025, this tax applies to estates valued at over approximately $13,900,000. This threshold is lower than the federal estate tax exemption, which means many estates in Oregon may face state estate tax even if they do not owe federal taxes. Now, how do trusts fit into this picture? Trusts are legal arrangements where one person, known as the trustee, manages assets for another person, called the beneficiary. They are often used in estate planning to help manage and distribute assets efficiently. When it comes to revocable living trusts, the assets inside these trusts are considered part of the grantor's estate. This is because the grantor has the ability to revoke the trust and retains control over the assets. Therefore, the value of these assets is included in the Oregon estate tax calculation. On the other hand, irrevocable trusts can be a bit different. If the grantor gives up control and ownership of the assets placed in an irrevocable trust, those assets may be excluded from the estate. However, if the grantor retains certain powers or benefits, those assets could still be counted in the estate. Then we have testamentary trusts, which are created through a will upon the death of the grantor. The assets in these trusts are included in the estate tax calculation since they are part of the probate estate. It is also important to note that if a trust owns real estate or other property in Oregon, that value is subject to the Oregon estate tax if the total estate exceeds the threshold. For practical estate planning, it is worth mentioning that Oregon does not have a gift tax. This means that using lifetime gifting strategies with irrevocable trusts can be an effective way to reduce the taxable estate and minimize Oregon estate tax exposure. Because Oregon's estate tax threshold is much lower than the federal exemption, many individuals who do not owe federal estate tax may still find themselves liable for Oregon estate tax. Effective estate planning, including the strategic use of trusts, can help manage or reduce Oregon estate tax liability. For example, transferring assets into irrevocable trusts during one's lifetime can help remove those assets from the taxable estate. Farms and ranches in Oregon are often valued over $1 million and can be particularly vulnerable to the Oregon estate tax. Specialized planning using trusts and federal gift tax exemptions can help keep these assets in the family and avoid forced sales due to tax burdens. In summary, the Oregon estate tax does affect trusts, especially those where the grantor retains control or where the trust assets are considered part of the estate at death. Proper estate planning is essential to manage Oregon estate tax exposure effectively. Consulting with an attorney who specializes in elder law or estate law can help tailor strategies to minimize tax impact while achieving estate planning goals.